$29 trillion. That is the number the Organization for Economic Cooperation and Development published on March 4th, 2026 in their annual Global Debt Report. $29 trillion is how much the world's governments and corporations plan to borrow from bond markets in the single year ahead of us. Not over a decade, not over a decade and a half, this year. One calendar year. That is 17% more than in 2024. It is double what the world borrowed just 10 years ago. And the bond market those loans will flow through? $109 trillion in outstanding debt. 93% of world GDP. Let me show you what that number means in practice. The entire global economy, every factory, every service, every export is barely larger than the pile of debt sitting behind it. These are not projections from a financial blogger or a market research bulletin. They come from the OECD, the Organization for Economic Cooperation and Development, the Paris-based institution that monitors economic policy for 38 of the world's wealthiest countries. Every number in this video comes from verified institutional sources: the OECD Global Debt Report 2026, the Federal Reserve, the Bank for International Settlements, and the IMF. Bloomberg and Reuters covered the report within hours of its release. According to Reuters, refinancing needs reached a record $13.5 trillion last year. The numbers are public, verifiable, and they are telling an uncomfortable story. And the report's title tells you exactly how worried the people who track this for a living actually are. The title is not Record Growth in Global Finance. The title is Sustaining Debt Market Resilience Under Growing Pressure. If this kind of analysis 3 layers beneath the headline is useful to you, the subscribe button makes sure the next one reaches you. We do not do noise. We do the mechanism. By the end of this video, you will understand 3 things. First, how a global debt machine works while everything looks calm on the surface. Second, exactly when and why it stops working, using 2 episodes from history that carry the same structural fingerprints as what the OECD described in its March 2026 report. Third, what the change in who holds that debt actually means for you, not for sovereign wealth funds, not for the Federal Reserve. For your mortgage rate, your pension, your savings account. The mechanism is not complicated, but it is buried inside language designed to make it sound boring. We are going to translate it step by step. Let me take you back to August of 1982, Mexico City. The Mexican finance minister Jesus Silva Herzog picked up a telephone and called 3 people: the chairman of the Federal Reserve, the secretary of the United States Treasury, and the managing director of the International Monetary Fund. The message was 3 sentences. Mexico had $80 billion in external debt. Mexico could not service that debt. And Mexico was requesting an emergency 90-day moratorium, a pause in repayments. Not a default, not yet, a pause. What happened in the years before that phone call is the real story. In the 1970s, global interest rates were low, not slightly low, near zero in real terms. And Latin American governments, Mexico, Brazil, Argentina, Venezuela, were borrowing heavily from US and European commercial banks. In Mexico's case, the logic seemed airtight. A massive oil field called Cantarell had been discovered in 1976, one of the largest in the Western Hemisphere, with reserves vast enough to transform Mexico's fiscal calculus entirely. The government borrowed against that oil revenue. The oil would repay the loans. The math was clean, except the loans were denominated in US dollars. Except they carried variable interest rates, adjustable every 6 months. And except in 1979, Federal Reserve Chairman Paul Volcker raised US interest rates sharply to crush American inflation. Rates did not tick up, they surged. That shift from cheap money to expensive money is the central gear in every debt crisis. The numbers tell the rest. Latin American debt service costs nearly doubled within 2 years. Mexico's economy had been growing at 3.3% per year since 1960. By 1982, growth had stalled. Oil revenues had collapsed, prices had fallen sharply on global markets. Same asset, same debt structure, completely different rate environment. Loans that were manageable at 4% became catastrophic at 14%. By 1983, 16 Latin American nations had rescheduled their debts, according to Federal Reserve's own historical record of the crisis. External debt for the region had quadrupled from $75 billion in 1975 to more than $315 billion in 1983. Debt service alone, just interest payments and principal repayments, grew from $12 billion in 1975 to $66 billion in 1982, in less than a decade. From $12 billion to $66 billion. Not because they borrowed that much more in that final year, because the cost of servicing what they had already borrowed had exploded. Here is the detail from that crisis that most people miss. The loans were not long-term, fixed-rate bonds locked in at favorable rates. They were short-duration, variable-rate instruments. Governments had taken on cheap debt but left themselves fully exposed to repricing. When the world changed when Volcker raised rates, there was no hedge, no cushion, no time to adjust. The maturity structure of the debt was the mechanism that turned a manageable situation into an uncontrollable one. It was not the level of debt alone that broke Latin America. It was who held it, at what price, and how quickly it had to be rolled over at the new price. The losses to U.S. banks alone from that crisis were described by the Federal Deposit Insurance Corporation as catastrophic. The 9 largest U.S. money center banks held Latin American debt amounting to 176% of their total capital. Now here is the sentence I want you to carry into the rest of this video. The maturity structure of debt is not a technical footnote. It is the difference between a manageable burden and a triggerable crisis. Write that down, because we will come back to it in 3 minutes. Let me pause here and make sure this first pattern is completely clear. Governments borrow at low rates during a cheap money period. The debt accumulates. Rates rise either because inflation forces a central bank to act or because creditors demand more compensation for risk. Refinancing that debt becomes dramatically more expensive. And if the maturity of the debt is short, if the bonds are coming due soon, the cost impact is fast, concentrated, and simultaneous across the entire portfolio. That is what broke Latin America in 1982. Keep that mechanism in your head. The second historical anchor is Japan. Not the asset bubble of 1989, that story is well told. I want to take you to what came after. 1993, Tokyo. Finance Minister Hirohisa Fujii and the Finance Ministry were sitting with a specific problem: a banking system full of bad real estate loans, a stock market down roughly 60% from its peak, and a population that had abruptly stopped spending. The government's response, conventional economic logic, was to borrow and build roads, bridges, stimulus programs year after year. They ran fiscal deficits continuously. Central government debt climbed from roughly 60% of GDP in 1990 to over 100% by 2000, then to 150, then beyond. Japan became, over 3 decades, the single most indebted major economy in the world as a share of GDP. And yet it did not collapse. It did not default. It did not even face a serious bond market crisis until 2022. Why? Because the Bank of Japan was the dominant buyer. The central bank absorbed supply that no private investor would have willingly absorbed at those yields. It stepped in continuously, at scale, as the buyer of last resort. And because the Bank of Japan would always buy unconditionally, programmatically, private investors knew yields would be supported. They could hold Japanese government bonds without worrying about price deterioration. The market was in effect guaranteed by the buyer, who could print the currency the bonds were denominated in. This created a functional equilibrium. Expensive to build, cheap to maintain, and completely dependent on the continued presence of that one unconditional buyer. Now here's what happened when that buyer began even cautiously to step back. When global inflation returned after 2022 and the Bank of Japan began normalizing policy, per the Bank for International Settlements, Japanese bond markets experienced yield curve volatility at levels not seen in a generation. Even the smallest rate moved from a base of near zero, produced enormous stress in a system loaded with debt, priced for a world where rates never moved. That is duration risk. A small change in the rate environment produces a large change in the value of outstanding debt. The Japan lesson: a central bank as unconditional buyer creates artificial, durable stability, but builds a structural dependency. Remove that buyer, and the system must find a new equilibrium at a higher rate. The cost of every outstanding bond reprices upward simultaneously. That is the Japan lesson written in 3 decades of data. And it is also a preview. Because here is what makes 2026 different from any prior cycle. The 2 pressures we trace through history, the maturity trap of Latin America and the buyer dependency of Japan, are not sequential. They are not unfolding in different countries in different decades. They are converging in the same system, in the same moment, layered on top of each other. Governments borrowed heavily at low rates before 2022, the Latin American pattern. The central banks that absorbed that debt are now stepping back, the Japan pattern. And a new category of borrower, the AI hyperscalers, is entering the market at precisely the moment when the existing buyer base is thinning. 3 pressures, 1 market, 1 window. If you want the sources behind this analysis, the specific reports, the institutional data, the historical records, they are organized and verified for you. And if this channel is giving you frameworks that the mainstream financial press does not provide at this level of depth, the subscribe button keeps this channel going 1 click. Now let me show you the OECD report published on March 4th, 2026. because it describes in the careful language of institutional economists the same two vulnerabilities we just traced through history, simultaneously, in the same system, right now. Look at the numbers. OECD sovereign debt outstanding reached $61 trillion in 2025. That is up from $55 trillion in 2024, $6 trillion of new sovereign debt added in a single year. Sovereign issuance. The volume of new government bonds planned for 2026 is projected at $18 trillion, up from $12 trillion in 2022. 50% growth in 4 years, and refinancing needs in 2025 alone reached a record $13.5 trillion, 80% of total gross borrowing. Here is what that means at a human level. A government that borrowed at 2.5% and now faces a refinancing rate of 4.5% is not just paying more. It is transferring fiscal capacity, the budget space it previously used for infrastructure, healthcare, education, into the pocket of bondholders. The spending decisions do not change. The debt service does. Here is the statistic that should stop you. 1/3 of all fixed-rate OECD government debt matures by 2027. 60% of that debt was issued before 2022, meaning it was issued during the era of near-zero rates, before the rate hiking cycle began. Translation: governments borrowed trillions at 2.5%. Those bonds are now coming due. They will be refinanced at rates that are significantly higher. The interest bill rises automatically, not because governments chose to spend more, because time passed and the world changed. This is the Latin American maturity trap at global scale, running through the balance sheets of the wealthiest countries on Earth. The OECD estimates refinancing this cohort of pre-2022 debt could raise interest payment to GDP ratios by an average of 0.2 of a percentage point across member countries. Across $61 trillion in outstanding debt, that is not an abstraction. That is real fiscal pressure, compounding each year. And now the second vulnerability, the buyer base. This is the Japan parallel, playing out in slow motion. For the decade after 2012, central banks were the dominant buyers of government bonds. During quantitative easing, they purchased trillions in sovereign debt, keeping yields low and ensuring that even record issuance was absorbed without causing rates to spike. That era is ending. Central banks are now running quantitative tightening, reducing their balance sheets. The OECD documents the shift precisely. Central bank holdings of domestic sovereign bonds in OECD countries fell from 29% of total outstanding debt in 2021 to 19% in 2024. 10 percentage points of the market disappeared in 3 years. Meanwhile, domestic households' share of sovereign debt grew from 5% to 11%. Hedge funds, retail investors, foreign buyers seeking yield, price-sensitive buyers who, when the yield does not compensate for the perceived risk, will not buy. And when they will not buy, yields must rise. And when yields rise, the cost of refinancing that existing pre-2022 debt increases further. Here is what the OECD's own economists call this transition: a shift from price-insensitive demand to price-sensitive demand. Translation: the buyer who would always show up regardless of yield the central bank has left the room, and the buyers who replaced it are reading the price tag very carefully before deciding whether to stay. Before we go to the next layer, here is the mechanism in plain language. Governments borrowed heavily before 2022, when rates were near zero. Those bonds are now maturing and must be refinanced at current higher rates, automatically raising interest payments across every OECD government simultaneously. The central banks that absorbed this supply have pulled back. Hedge funds, households, and price-sensitive institutions fill the gap, requiring higher yields to compensate. Higher yields raise the cost of refinancing further. Not a crisis today. A structural pressure compounding quietly each quarter. Quick question for you. What concerns you more about this picture? The volume of sovereign debt coming due by 2027, or the new buyer base that has to absorb it? Drop a comment with your thinking. These responses directly shape what we analyze next. Now add one more element. The OECD explicitly flags this as a new structural change, beginning now: the AI hyperscalers. 9 technology companies, the largest AI infrastructure builders in the world, raised $122 billion in corporate bonds in 2025 alone. According to the OECD Global Debt Report 2026, that represents nearly half of all technology firm bond issuance globally in a single year. Their forecasted capital expenditure from 2026 to 2030 is $4.1 trillion. The OECD report notes that this figure is 1.1 trillion more than total capital expenditure, by all U.S. non-financial companies in 2025 combined. Every manufacturer, every retailer, every logistics firm. 9 companies plan to spend more on AI infrastructure in 5 years than all American non-financial industry spent on everything last year. Here is the picture. Governments on one side issuing 18 trillion in sovereign bonds this year. AI companies on the other adding a new and rapidly growing layer of corporate issuance, both competing for buyers who are more price sensitive than any buyer base this market has seen in a generation. The market must clear. The only question is at what yield. So what is actually new in 2026? Governments are borrowing at record levels. Central banks have stepped back. 9 technology companies are now competing in the same market. More demand for capital, fewer guaranteed buyers, higher costs for everyone. And they will finance a significant portion of that through the same bond markets where governments are simultaneously competing for capital at record volumes. If half of the 4.1 trillion in AI capex were funded via bonds, the OECD calculates, those 9 companies would represent 15% of global historical average annual issuance by non-financial companies. 15% of a market already absorbing record sovereign supply, already dependent on price-sensitive private buyers to fill the gap left by retreating central banks. The mathematics of supply and demand are straightforward. More demand for capital from a constrained buyer base means higher yields. Every participant in this market, governments, AI companies, corporations, households, faces a higher cost of borrowing, not temporarily, structurally. Let me bring this to you directly, not to sovereign wealth funds, not to central bank policy committees, to you. Here's the transmission mechanism. Governments borrow more, issue more bonds, and compete for buyers. To attract those buyers, yields rise. Rising government bond yields are the reference rate for a significant portion of household borrowing mortgages, car loans, home equity lines. Not immediately and not overnight, but directionally and persistently over time. The OECD's Consumer Finance Risk Monitor, released alongside the March 2026 debt report, explicitly flags that elevated long-term government bond yields are already feeding through to household borrowing costs across multiple major economies. The mechanism is not theoretical. It is already running in the background of your financial life. For pension funds, the picture is more complex. Higher yields on newly issued bonds eventually improve the long-term return on fixed income portfolios. But the transition period, the months and quarters during which existing bond values fall, as yields rise, creates mark-to-market losses that reduce the apparent health of pension funds in the near term. If you are within 10 years of a planned retirement date, this transition period is not an abstraction. It is a window of risk. I am not a financial advisor, and none of this is investment advice. But the data describes a sustained period in which the cost of borrowing remains elevated. Competition for capital intensifies across sovereign and corporate markets simultaneously. And the buyer who used to guarantee smooth absorption of government debt is no longer playing that role automatically. That is not a prediction of systemic collapse. It is a description of a structural tension that will shape the pricing of credit, the cost of mortgages, the performance of pension funds, and the fiscal space of governments across the wealthiest economies for years to come. Here is where every thread in this video connects. Record government borrowing, central banks pulling back, price-sensitive investors filling the gap and requiring higher yields. Those yields feed through to mortgages, business loans, and consumer credit. Pension funds face a transition period revaluation. And now, for the first time, 9 AI companies are competing with governments for the same capital pool. Each element compounds the others. That is the machine as it runs in 2026, not a moment of crisis, a structural ratchet, tightening. We read every comment in the discussion below this video. Real engagement shapes which structural dynamics we examine next. What does the evidence suggest you pay attention to, not as trading signals, but as structural indicators? 3 things. First, sovereign yield curves, specifically the spread between short-term and long-term government bond yields in major economies. When long-term yields rise faster than short-term rates, markets are demanding a higher risk premium for lending to governments over extended periods. That is the bond market's real-time vote on fiscal sustainability. Watch it monthly. Second, central bank balance sheet trajectories. The pace of quantitative tightening in the US, the Eurozone, and the UK determines how quickly the price-insensitive buyer is exiting the room. A reversal, a return to quantitative easing would signal that the system cannot absorb its own debt requirements at market clearing rates without central bank support. That reversal, historically, has preceded significant currency and inflation dynamics. It would not be a reassuring signal. Third, the AI CapEx bond issuance calendar. 9 companies now compete with governments for the same capital. Watch for correlation. When AI bond issuance accelerates and sovereign yield spreads widen at the same time, the compression is becoming measurable. The OECD flagged this interaction explicitly in that same report as a new and underpriced risk in bond markets globally. Those 3 indicators, yield spread, central bank balance sheet direction, AI bond issuance pace, are not predictions. They tell you whether the structural pressures described in this video are accelerating or stabilizing. Review them quarterly. One more thing worth understanding about timing. The 2027 refinancing wall is not a cliff. It is a slope that has already begun. 13.5 trillion in refinancing happened in 2025. It will happen again in 2026 at even higher volumes. Each wave of refinancing rolls pre-2022 low-rate debt into current-rate debt. The process is mechanical and largely unstoppable in the short term. Governments cannot simply not refinance maturing debt. They have to. The only variable is the rate at which that debt is repriced and the composition of buyers willing to absorb it. That is why the OECD called this moment a stress test. Not because the market is broken, because the variables that determine whether the machine continues to run smoothly are all moving in the same direction at the same time, for the first time. Understanding that is not pessimism, it is precision. The investor, the homeowner, the pension participant who understands the mechanism is in a fundamentally different position from the one watching only the headline number. The headline says 29 trillion. The mechanism says, watch who buys it, at what rate, and what they replace when they do. The OECD published this report on March 4th, 2026. The financial press covered the headline number 29 trillion. Very few readers will get far enough to understand the maturity structure of that debt, the exit of the price-insensitive buyer, and the new compression that AI capital needs introduce into an already stretched system. That gap between headline and mechanism is exactly where this channel exists to operate. If this analysis was worth your time, the like button tells the algorithm to show it to people who do not know this channel exists yet. The pattern in the end has always been the same. Debt is manageable until the rate environment changes and the buyer base shifts. Rome did not collapse because it spent too much. Part of what broke Rome was the inability to fund its military commitments as the fiscal base eroded and the currency was debased, the same mechanism, running through a different system. For Latin America in 1982, for Japan through 30 years of carefully managed yield curves, and for the OECD world in 2026, the question is never simply whether the number is large. The question is whether the structure holding it is stable enough to manage the cost of carrying it forward. Right now, that structure is changing faster than the headlines suggest, and the OECD said so directly.